The fourth component of solvency that we will discuss is the level of available capital compared to required capital. Available capital acts as a buffer in times of adverse experience. For example, if there are a large number of claims due to a hailstorm. Regulatory requirements will set the minimum level for required capital. If a risk-based approach to solvency is used, the level of required capital should broadly reflect the risk faced by the insurer. Available capital should be greater than the minimum required capital for the insurer to be solvent. Stress tests on available capital can give insights into the impact of adverse events on the available capital. Solvency cover, or the ratio of available capital to required capital, is an important ratio in assessing the solvency of an insurer. The solvency cover should be greater than 100% for the insurer to meet the minimum level of the required capital. Decreases in solvency cover and the level of available capital will indicate a deterioration in the solvency position. It is also important to understand the impact of possible decreases in the level of assets or increases in the technical provisions on the level of available capital using stress tests. Investigating the required capital for individual risks, for example, market risks, in the calculation of the required capital can give insights into the relative exposure of the insurer to different risks. Warning indicators that would raise concerns around the available capital of the insurer could include the following: a failure to meet the solvency targets, a solvency cover very close to 100%, significant changes in the solvency position, and non-compliance with the minimum level of required capital after stress tests are performed. The supervisor could take the following actions if they identify weaknesses in the available capital of the insurer. The supervisor could investigate the main risks to solvency in greater detail, possibly in an on-site inspection. The supervisor could require the insurer to submit a plan to improve its solvency position and require more frequent reporting from the insurer. The supervisor could require the insurer to increase its level of capital, especially if the business is a higher risk than the risk of the average insurer in the markets. The supervisor could instruct the insurer to reduce its risks or possibly to revise its reinsurance programs. In more extreme circumstances, the supervisor could limit the amounts of business written and stop the sale of new policies, and also restrict the payment of dividends to shareholders. There is a forum looking at the available capital. Please give suggestions on other early warning indicators and possibly interventions for available capital in the forum.